This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Eric Peters back onto the show. You know, whenever you're talking about these managers that were long volatility into this crash, I can name even 3 or 4 of them that just did great jobs hedging this downside risk. And it was really great to hear his insights on how things are developing. What did you take away from the interview?
The thing that stood out for me, Patrick, was the discussion about inflation. And it's something that I've said for years is I don't know when we get a return to secular inflation. I'm not smart enough to know that. It's beyond my pay grade. What I do know is I think that's where the game changes, where suddenly central bankers can't solve every problem with printed money, and all of a sudden the rubber hits the road, so to speak. I've noticed a pattern, Patrick. A lot of the smartest people that we have on the show recently, whether it's Eric Peters in this interview, Pippa Malmgren earlier this week, several other feature interview guests are starting to talk about not just a little whiff of inflation, but a shift back towards secular inflation and the possibility that the COVID-19 crisis and the resulting government stimulus, which is just beyond belief, is what takes us there and gets us out of this deflation that we've been in for more than a decade now and into a new round of secular inflation. So I want to continue asking our expert guests about that topic. I think it's going to be incredibly important to follow. But for now, Patrick, we've got another of your famous Postgame chart books. Listeners, you'll find the download link in your Research Roundup email. Now, if you don't have a Research Roundup email, that means that you haven't yet registered for a free account at MacroVoices.com. No problem. Just go to our homepage, MacroVoices.com, look for the red button that says Looking for the Downloads right next to Eric Peters' picture. Patrick, diving into the Postgame chart book, on page 2, we've got the S&P trajectory. I think you and Kevin Muir, we were down at what, like 250, 2,300 when you guys said it's time for a bear market rally to take us back to 2,800. So congratulations on the call. We're there.
Oh, yeah. It's, well, I mean, the chart here is just the analog of what would it look like if we did 2008, 2009. It wasn't necessarily a forecast, but that was certainly the way we were positioning in the market. Like we were just so oversold. A reflexive rally is just par for the course for the way the market naturally behaves. But for the first time since the market top, this is a very, this level on the stock market is high interest to me because it's starting to get asymmetric to explore the downside, especially as volatility is contracting and those crazy vol premiums that we were seeing in the 60, 70, 80% ranges have backed off quite a bit. Anyway, all I wanted to keep doing on this chart was just keep showing members an analog of 2008, 9 and see whether or not this compares or will work out similar to the post-Lehman period. Not necessarily a forecast, but it'll be interesting to see how it plays out. One thing I do think is, though, that the market is still likely to go lower. I think a lot. What usually happens during bear market rallies is the rally lasts long enough to convince everyone it's real. And only when everyone starts talking like, you know, it's going to keep going up and I missed it and all these different things, usually that's from a sentiment perspective when you can really realize that it's run its course. And that's certainly something we're going to continue to watch.
What do you think about my theory that next week-ish, maybe end of next week, possibly into the following week, we get a reduction in the number of new COVID-19 infections, and that, I think, is potentially the trigger for the last blow-off top before reality sets in. How does that jibe with what you're predicting here?
That certainly is possible. The one thing that almost always happens is that there has to be huge volatility, both higher and lower, to whipsaw, to drive and knock out stop losses in the weak hands. This is not going to be an easy top to catch on this. I think that there's a number of fake outs. Maybe we'll see next week start with a big sell, and then suddenly what we'll do is there'll be a huge jump maybe towards 2,900 just to wipe everyone out that went short, and then it'll roll. So the market has a tendency to make it very difficult to catch this turn. So I think maximum volatility is what we should expect.
Moving on to page 3, my favorite topic, crude oil. What do we got here?
Well, I just wanted to show the chart. I mean, overall, for the fact that we were talking this big production cut and all of these different things, like Trump's tweets, oil is not far from its key lows, right? Like, I'm actually just reflecting and taking a step back and looking at this chart, and crude looks incredibly distributed. It's a very weak-looking chart, and so it's just not impressive to me at all. This chart shows that we're heading right back down to the base, almost near the lows, right?
Exactly, Patrick. And the thing is, this is just the flat price chart, the front month price of crude oil. And this is where it gets deceptive. We've had so many listeners that have said on Twitter or in emails that they've sent us, how can I possibly go wrong? It's going to hit $20 again. If I buy that low, if I buy oil for $20, okay, even if it goes to 10, I can ride it out, and I know it's going to go back to $50 someday. The problem is there is nothing that's just called oil that you can buy with a symbol and get that $20 price and sell it when it's $50. Now, we covered this a couple of weeks ago, but we got quite a bit of confusion, I think, and questions on Twitter and so forth. So I want to move on to page 4, which is showing the crude oil term structure. That little dot at the bottom there, that is the May 2020 delivery contract, and that's expiring next week. The next dot above it is June, and then July, then August, then September, and October, and so forth. Now, if you go about 6 or 8 months out, you see how the dots are all close together. Normally, if you're that guy who said, I bought $20 because it just seemed like a great deal, if you bought one of those dots that's further out on the curve and you had to roll it forward to the next month's price, which you have to do at the end of each month, well, gee, those dots are just really close together. What's the difference there? It's like 20 cents or something. I can just eat that as a little bit of a friction cost of trading. Forget about it. What happens is it's not too important to the speculator who's long crude oil that there's that little bit of roll premium that it's called every month until you get a situation where storage is an extremely high demand. And in this case, it's because we've got too much oil and no place to store it. And then what happens to the term structure is this shape you see here, which we call super contango, huge amount of vertical space between those dots. The easiest way to explain why this happens and how it happens is to think about it from the perspective of the different traders in the marketplace. The guy who bought the May contract for $20 because it just seemed like such a bargain really was just thinking about, having crude oil for the next umpteen couple of years or something and selling it later. When he goes to roll that contract at the end of the month, normally the person on the other side of that might be one of the commercials. Those are people who have great big tanks full of oil. So they're long physical crude oil and they're short futures contracts. So when you want to sell your May contract and buy a June contract, the guy who is buying your May contract and selling you the June contract is usually somebody who owns physical oil in one of these storage tanks. Under normal circumstances, that guy with the tank is saying, okay, that profit of 20 cents or so, well, that's about all I can get if I were to deliver my oil into the market. Instead of rolling my futures contract forward, if I were just to deliver the oil that I have, that I'm short, into the market, my tank would be empty and I might not be able to find anything to do with it. Well, in this environment right now, Patrick, if you control a physical oil storage tank, the mafia is probably talking to you because they want to have a conversation with you about your tank. So these guys know that they're in a position of power. And what they say is, you know what? So you Mr. Retail Trader, you've got to roll your May contract into the June contract, which normally costs a premium of about 20 cents. This month, right now as we're recording, Patrick, let me just look, it's $5.99 for the May to June contract. That's $6. So you're losing almost 1/3 of the value of your investment just in the 1 month roll forward. Well, if you're the investor, you say, hey, buddy, you're trying to take advantage of me. I'm not going to do that. Here's the thing, Patrick. You have to close your May futures contract by the end of next week, or you have to accept physical delivery of 1,000 barrels of crude oil. Those are your only choices. The retail trader doesn't have a tank to put that oil in. He has to do it. Now, the other guy, the commercial, he's got the oil in a tank, and he has the option to deliver it into the market. So the retail guy says, I won't do it. That's too much. $6 just to roll my position for 1 month? That's crazy. The guy on the other side says, yeah, it's really crazy. And it's going to be $6.50 in the next hour if you don't act right now, because the closer that we get to expiration, when there's just no storage available, the guy that owns the tank basically owns the gold. So what happens is in 1 month, you're readjusting your basis from $25 to $31. You're giving up almost 1/3 of the value of your investment in that roll premium. And that's the reason that it's possible to buy oil for $20 and then go to sell it when oil is at $40 and still lose money on the trade because you lost money on those contango rolls. And what we can expect is for this super contango structure to continue for the next several months because of the shortage of storage capacity. Now, this creates tremendous trading opportunities, Patrick. If you take a look at, let's go, 1, 2, 3, 4 dots from the bottom up on this chart on page 4. Let's suppose that you were to short a 1 month futures time spread. In other words, you might say, if that's May at the bottom, June is the next one, July is the next one. Let's say you're going to sell August and buy September. Well, they're only what? It looks like at this moment, they're about 40 cents apart. So you're shorting it for an entry price of 40 cents. You wait a couple of months until that thing's about to expire. And if the same storage conditions still exist then, which exist today, that spread might have blown out, as has happened on the May-June spread, to $6, and there's a huge profit there. So this contango expansion trade can be very profitable. Now, of course, eventually, when the storage crisis goes away, when the economy is restarted and everything's back to normal, that contango is very quickly going to come out of the market, and the trade can reverse on you in a moment's notice. So you've got to stay on top of the headlines and make sure you know what's going on in the world. But from a futures trading standpoint, this can be a very effective trade. Now, the thing we've gotten a lot of listener interest in is they're saying, look, Eric, you got to be able to trade future spreads. That's kind of professional trader stuff. It's really not within the reach of the average retail trader. Is there a way for retail guys to get involved in this same basic trade, and not by doing the future spread, but instead by buying shares in the companies that own the tanker ships, which are being used to store oil in addition to the on-land storage? Now, that's another way of thinking about this trade. I personally am a futures trader. The way I put this trade on is with futures spreads. Patrick, I know that you've looked at the tanker trade, and I think you and your members are actually in that trade. Tell us a little bit about the stock traders' approach to trading this same basic concept here and how it plays out.
Right. And so, first of all, I want to do a shout out for Harris Cooperman and other hedge fund managers like that have been all over this shipping story, because really I didn't originate the idea, but it is just a great way of expressing this trade. So on page 6, what we have is the crude tanker rates, which are showing the daily charter rates for these ships that store the crude, and they're north of $200,000 a day. Just to put it in context, last last year, the average rate was about $40,000 a day for the crude tanker at spot rates. And so these tankers, what they're essentially, a lot of traders like the ones you're describing are literally doing is buying spot, loading it up on these ships, selling forward into the futures market, locking in much higher prices, and then just paying the charter rates to actually just have this as floating storage. And what's interesting is that Morgan Stanley did an interesting interview with a number of the CEOs of these tanker companies, and we linked an actual article from Oil and Gas Journal that actually was on that conference call and detailed it. But it was just talking about that these companies, because they were really dealing in the spot market, going into this entire period, as much as anywhere, some of them CEOs were saying 87% to 95% of their vessels are available now to be booked into these at these higher charter rates. And so long as there's a lack of land storage, these ships are going to start being used as floating storage and actually reduce the fleet available and cause these charter rates to continue to skyrocket as there's a no-brainer for a lot of these companies to just buy the spot, pay that charter rate, and in the end deliver at a much higher price in the future.
Patrick, let's just explain why these tanker ships come into the equation and what they have to do with oil storage. Let's go back to page 4 again, listeners. Look at that bottom yellow dot on $25. That's the May delivery contract for WTI crude oil. Now, look, not the next dot up, but 2 dots up. That's the August contract. That's at about $33. So there's at least $8 of difference. That's called the calendar spread or time spread just for those 2 months. Well, wouldn't it be cool, without taking any speculative risk at all, if you could just say, hey, wait a minute, why don't I buy the May contract today and I'll sell the August contract today? So I lock in a price of about $9. And if you move on to the next page, on page 5, we actually show what that May to August spread looks like. And since this chart was printed, it's actually moved higher. It's $10 right now as we're recording on Thursday afternoon. Well, the idea is you buy the May contract. The thing is, if you just had a place to put that oil in your back pocket and store it someplace for a couple of months, you could then deliver into the August contract. And that difference, called the contango of $10 per barrel, instead of losing that to those guys that take advantage of you on the roll, you could keep that profit. In fact, you could lock in that profit without even having to know what the future price of oil is going to be, because you can use today's prices to lock in both the purchase and the May contract and the delivery on the August contract, and you can lock in both prices right now today and get a $10 differential. The thing is, you got to have some place to put the oil, and all of the storage tanks on land are completely booked. So the idea is you lease a ship which is normally used to deliver oil from one continent to the other, and you're just using it as a floating gas tank. You fill it up with crude oil, tell the captain to go anchor for a couple of months and bring it back when we get to the delivery dates for that August contract. And oftentimes what you'll do is you'll just end up calling the captain back and saying, hey, Cap, stay at anchor. We just rolled that spread forward because the August to September and September to October spreads had widened out. We were able to roll that position for August delivery into October, so just stay on the anchor there. We'll call you when we need you. If you have the sophistication to rent out a tanker ship, you can make a fortune. And the thing is, Patrick, it's not speculation. You can lock in that profit by chartering that tanker ship, and you know how much you're going to make. You're not speculating as to what the price of oil is going to be in August. You're using today's price for delivery in August. So that's how the trade works, but you got to have a ship that can store crude oil in order to do it. So I just wanted to explain that. Please continue with the story.
Well, that's the whole point. And so the charter rates for these ships are actually, susceptible to price discovery. And so the wider the spread is, the more profit there is. And the more profit there is, the more they can bid up the ships to lock them in so that they can actually make this trade. And so these ships have been, some of them in the last couple of weeks have been going for $200,000 plus a day. And so it was interesting. If one has a speculation that this contango is not going away for months, and it's going to stay, then these shipping companies are literally printing money. And it was interesting is that in that conference call in Morgan Stanley, the Euronav CEO, Hugo de Scoop, basically said that they have the potential to generate profit greater than the company's market cap this year if these rates persist throughout the year. So essentially, you have a scenario where if one is making a call that the contango is going to stay in there and these charter rates will stay there, these companies are completely mispriced for the amount of profit that they're about to print. Now, it's still a speculation, but if any
now you're saying that's profit. So the earnings per share, the EPS, is the same as the share price.
Yes. That's not insane. Oh, now, obviously, that's a speculation that those charter rates will stay there the rest of the year. Obviously, if the contango disappears and the charter rates in a couple months go back to $20,000 a day, then they had a nice profit boost. But the idea of how much profit they can make, they would have to sustain for the whole year for that number to be cracked.
Now, my question, Patrick, is, everybody, not everybody, but a lot of smart people know about this already. It seems like these charter rates that we're looking at were way up just in the last few days because of this OPEC cut nonsense. And again, listen to the interview with Art Berman if you want to understand why this cut really doesn't have as much relevance as the media would like to suggest that it does. There was a dip there, but it was very short-lived. We're back up to those high rates. So at this point, is the share price pretty much already, baking in the value that's there, or is there still an opportunity to make money by buying these shares?
Well, there's a lot of smart people out there putting some heavy money at this, thinking that it's not priced in. But really, the most immediate reaction over the last week has everything to do with the fact that supply cuts have a negative impact on the tanker market. So when that big headline from Trump came out, the first impulse is to hit the tankers the moment there's an idea that there's going to be a production cut. And so this is why the speculation really is on how much you really believe that OPEC is going to stick with this and that oversupply isn't going to be there. So long as there's going to be a huge amount of oversupply of oil and the lack of demand, these ships are going to get filled up pretty quick. And so this is a great way of playing the contango in the market.
Patrick, let's move on to the gold chart on page 7 here. You've got the price from earlier in the day here at 1746. That was pretty close to the high of the day. It did close a little bit lower than that, right around where that head and shoulders neckline would be at around 1730 or so. It looks to me like this chart's looking awful bullish, and I don't know about you, but I'm thinking 1922, which was the 2011 low, is not that far away.
Yeah. On the short term, the path of least resistance for gold remains heading upwards to 1800 or so, even higher. Like we could go back to fully retest the 2011 highs. I do think that this will be still very volatile, though. If we enter another period where the stock market goes into a liquidity event, it's going to be hard pressed for gold to kind of decouple from that broader noise that's going to come in the whole entire marketplace. So on the short term, I continue to think that gold is going to edge higher, but I don't think it's a free ride to just stay long. So we'll have to definitely see how it continues to develop.
Patrick, moving on to page 8. I had to catch myself today because I thought that I had drifted off asleep at my trading desk and I was having a dream. Because it's only when you have dreams that crazy things happen, like public officials that are supposed to be grown-ups decide that what the Fed, the Treasury, the Central Bank of the United States ought to do is buy junk quality credit in order to support the junk bond market. Now, when Michael Milken was playing crazy games in the junk bond market in the 80s, he went to jail and he was a sinister bad guy. I think he was even one of the characters that they based the bad guy on the Wall Street movies about. Now we've got Jay Powell doing it and nobody's arresting him. What the heck is going on here? Let's start with the story on what's happening with the Fed and junk bonds and then move into this chart.
Well, I just really wanted to point out the credit spread, because what ended up happening was the junk bonds just blew out. You had an 800 plus basis point spread over treasuries. And the moment the first wave of QE came in and they tackled the investment grade quality and government bonds, the spread just blew out even worse because they weren't touching the junk bond market. But what I think is happening is the Fed is realizing that they need to stabilize the entire entire credit market in order to prevent this from avalanching down the side of the cliff. And so they came in and they're buying high yield. And obviously we're already 200-300 basis points off of the highs. But what is interesting to point out is the credit markets had such a drastic event that the only time we've seen credit spreads blow out higher than this was 2008. And I just think it's really, you can step back and reflect on how this has developed. Now, obviously, with the Fed creating now an artificial market because they're going to be a buyer, keeping yields suppressed, it's going to be really interesting whether or not, credit risk is really been tamed or not. And that's something that I think we're going to have to watch in the coming months. Maybe we should bring a high yield guest on just to really kind of size up what this means to the market, because this is unprecedented. I don't think I wouldn't have ever thought, well, I mean, there are certainly people that would have speculated that we'd be here, but it is here, and it's amazing that we are, and I'm not sure how to interpret it.
Patrick, I still have some old leftover accounts receivable invoices for delinquent receivables from a business that I owned in the 1980s. I wonder if I can sell that to the Fed for 300% of original principal. I mean, what part of the word junk doesn't register for these people that they're spending public money to buy junk bonds? It absolutely amazes me that this is actually happening. I think that this coronavirus response, in my opinion, folks, is much worse than the virus itself. On a happy note, though, let's move on. You're doing a live trading session with our friend George Gammon. For listeners who went to our MacroVoices live event in Vancouver, George was the principal organizer behind that event, did all the legwork in order to make that possible, negotiating with the hotels for us. A live trading session online with you. What's it about, and how can people join in?
Well, I'm just doing it for all my paying members, but also George has promoted it on his end. But George wanted to learn more about options, so I said, well, why don't we just hold a live trading event where it's me and you, and we're going to go through a boot camp and educate all of our members just on all the amazing things you could do with options. We put a real focus on gold on it, and we're going to spend a lot of time talking about collaring and how to create synthetics in the gold market and to leverage this beautiful uptrend.
And of course, you get what you pay for, so that one is only for paid members of Big Picture Trading. You can find the information in signing up right here on the slide on page 10.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.